Joining us from Newport Beach, California, we have Tony Crescenzi, market strategist and portfolio manager at Pimco. Good to see you once again, Tony. There are some concerns, though, in terms of what the Fed is doing, the Fed actions. Do you think that there is, I guess, a heightened alert in terms of how bad the U.S. economy is doing?
The market had already decided for itself that the U.S. economy was weakening. That was reflected, of course, in the recent volatility in the equity market. And so this kind of reinforces that view. But at least it maybe helps to bring about a bit of confidence for those who were worried that the Fed might be falling a bit behind. Here's a case where the Fed needed to follow the markets rather than lead it. Of course, at some point, if the economy were to seem to be slipping further, the Fed would have to lead the markets and do more than it expects. But the Fed did today the least of what the market expected. Many were expecting this action or something along the lines of a hint at action, and that's what they received, but no more.
Okay, but so we have the Fed keeping its balance sheet stable, basically. Do you think this is enough to spur investors to take on more risk? Should they have expanded?
Well, this has been the effort since November 2008 when the Fed announced that it would purchase securities. It's continuing the effort, of course. What the Fed engenders to do is push investors further out the risk spectrum. This has been occurring for a while. By the reflation of asset prices, the Fed achieves a transmission effect. There are many transmission effects of monetary policy. One of these includes the inflation of asset prices, which through the various channels, for example, by lowering the cost of capital to those companies that borrow in the stock market, and IPOs this year were dramatically higher than last year, through a lower cost of bond yields. Of course, these are ways that companies can benefit, and people benefit through the wealth effect channel. So the transmission effects of this sort of action can be helpful, but it's fighting against very big structural issues in the economy, the deleveraging that's occurring, very big and high levels of unemployment in industries that are structurally impaired. And one quick example, think of the construction industry. 7.5 million people employed at the peak of the housing market. 5.5 million people now. That's 2 million jobs lost. Imagine in that sector and in other sectors such as automobiles, finance, retail, commercial real estate, jobs lost that won't be recovered easily, certainly not by adding a couple $100 billion into the banking system. These jobs are lost because the levels of economic activity in those industries is too low to support the prior levels of employment.
Okay, so Tony, we have lagging job growth in the U.S., but also we have a ballooning budget deficit for the U.S. government. What should be the focus right now for the Fed and also for the Obama administration? Should it be austerity or should it be stimulus? Obviously, there's a lot of debate about this.
Well, politics is a funny game, and it seems what the politicians want will ultimately be what the people want. It seems what the people want now, from what businesses are saying, is to be left alone, we could say. So it could be that policy is shaped by a reduction in government involvement, but we would expect government involvement to stay high because populism is the big thing right now. But a reduced level of it seems to be what's in the offing. And some change in the atmosphere in Washington seems likely in November because there'll be some shift in the amount of seats, of course, held by one party versus the other. Democrats expected to lose a large amount of seats to Republicans. And this will probably push the country toward the center in terms of policy making. And so the Obama administration will be forced probably by the public in terms of what it wants, which is a little bit more of a move to the center than from the left, as it has been, as many perceive in the business community.
Okay. Tony, let's try to talk about how to invest off of what the Fed has announced today. You know, you said that the lower volatility coming from the Fed keeping its balance sheet stable means lower yields. Have you looked at the 10-year yields recently, now hitting an 18-month low? I mean, the last time the yields were this low, you have to go all the way back to 1955 when the economy was still expanding.
Well, remember, the low interest rate has to be put in the context of what it's low versus, and that means the inflation rate, of course, and the policy rate. And so versus those things, the interest rate doesn't look abnormally low. And, of course, there's this technical issue now with the Fed purchasing securities. Remember, when the policy rate is expected to stay low, it engenders a whole variety of investment philosophies. One, of course, is the idea that volatility will be kept low, and low volatility tends to be good for the interest rate climate because it takes out some of the term premium, and it does push investors out the risk spectrum generally, and that tends to be good for risk assets.
Tony? Pleasure to speak to you. Tony Crescenzi, market strategist and portfolio manager
Thank you
at
so much.
Pimco.